Hello, Assalamu alaikum students. This is your teacher Azka, and I teach business and accounting to O and A level students. So first, before starting this video, I am just want to share one news with you that I'm going to start my past paper sessions for O and A levels accounting for May 2 session 2025. And this past paper session is going to start from the 1st April. So if you want to enroll in the classes, so you can send me text on my WhatsApp number. Or you can also maybe comment under this video. So you have these options to contact with me. And the fee is very minimum. This is only 8,000 Pakistani rupees per month. Okay. So for today, we are going to solve this question, the paper for A levels accounting paper 4. This is cost and management accounting, and this is October-November 2024 series. Paper 4 variant 2, and we have 1 hour to complete the whole paper. Okay, so first of all, we have this source A for question 1. So in this particular question, we have the information. This whole question is basically from the budgets. So T Limited manufactures one product which has been on the market for many years, and it operates a standard costing system. The budgeted sales for August were 22,000 units. So these are the budgeted units. This is not the actual units. Standard cost comprises, one like per unit cost is direct material cost 3 kilo at $8 each is equal to $24. Direct labor is equal to $60 and the fixed overheads is equal to 40, and the total cost for standard unit cost is $124. And we have the variance analysis. The sales basically in units was 2,000, but the actual results are that there are 1,800 units they only sold. So this is the sales figure, and this is the variance, favorable variance. And this is adverse variance of direct material. This is favorable variance for direct labor. This is again adverse variance for fixed overhead. This is adverse variance for overhead capacity. Favorable variance for fixed overhead efficiency. And this is the profit, the actual profit. Okay. So now what is the requirement? Now let's see the requirement. Okay. So we have the first question in which we just need to explain two reasons that why business may conduct variance analysis. So basically, 2A and B part is the theoretical parts. So that's why we will do it at the end of this video. First of all, I'm going to solve the C part. Okay. So basically, we are given our variance analysis for T limited, and we need to prepare a flexible budget statement for August. Okay, so a flexible budget adjusts the budgeted figures based on the actual sales and the production levels. So first of all, we know that our total standard cost per unit is $124. So what does it mean? It means that company had initially planned to produce and sell 2,000 number of units in August. Okay, and each unit was expected to cost $124, and which includes material, labor, and overhead. So what was the actual performance? So actual performance for August was this. Actual sales were only 1,800 units, okay, and actual sales revenue is 2,39,400. Actual direct material is this, okay. Actual fixed overheads and actual labors is equal to 1,06,020, okay, and actual profit is equal to 4,740. And we already given the analysis. So as you can see that sales price is $5,400, and this is basically favorable analysis variance. What does it mean? That the T limited sold at a higher price. And the total direct materials, which is 1414, this is adverse analysis, adverse variance, sorry. It means that T limited spent more than expected. The favorable variance for direct labor shows us that we spent less on labor. And again, the adverse fixed overhead expenditure shows us that is spent more than budgeted. Fixed overhead capacity is adverse. It means that there's a lower production resulted in the higher per unit cost, and there's a favorable fixed overhead efficiency. It means that labor efficiency saved some overheads. So it means that company basically sold 1,800 units instead of 2,000. So we must adjust the budget accordingly. So the variance indicates that which costs were higher or lower than expected. So since the actual sales and productions were 1,800 units, so we adjust the budget figures for this new level of activity. Okay, so first of all, okay, so what was the actual sales revenue? Okay. Okay, so actual sales revenue was 2,39,400 and sales price variance was favorable, which is 5,400. So now we need to prepare a flexible budget sales revenue. So what we need to do, we need to deduct the sales price variance, which is favorable from the actual sales variance. So this is equal to uh, 239,400 minus 5,400. So this is equal to 234,000. So basically, although actual revenue was 2,39,400, this includes a favorable variance of $5,400 because the company sold at a higher price. To remove this effect and get the expected revenue at the standard price, we subtract the 5,400 from here. Now let's adjust the direct material cost. So actual direct material cost was 44,640. If you just open the question paper in front of you. So total material variance was adverse, which is 1,440. So it means that now is equal to 44,640 minus 1,440 is equal to 43,200. So basically per unit material cost, standard cost was $24 and expected material cost for 1,800 units was what will be 1,800 multiplied by 24. Yes, so this is same. This is just a verification. So basically, actual material cost was higher than expected by 1,440. Okay. So to get the flexible budget figure, what we should have spent at standard cost, we subtract the unfavorable variance from the actual cost. Now we are going to adjust the direct material cost. Sorry, direct labor. So basically, actual direct labor cost was 1,06,020 and labor variance was favorable, which is 1,980. So to find out the flexible budgeted direct labor cost, what we need to do, we need to add the 1,980 in the actual direct labor cost. Okay. So basically, actual labor cost was lower than expected by 1,980. To remove this favorable variance and get the budgeted labor cost for 1,800 units, we add back the variance to the actual cost. Okay. So now we are going to address the fixed cost. So actual fixed cost was 84,000. Okay. And the total fixed overhead variance was reversed, which is 12,000, includes the expenditure and capacity variance net of the efficiency variance. So it means that now 84,000 minus 12,000, we have 72,000. So if you just want to verify it, so the per unit fixed cost was standard was $40, and the expected fixed overhead for 18 the units which we actually sold out, which is 1,800. So you can just multiply 1,800 to 40, so you will be get the same answer. This is the kind of verification you can, if you want to do, you can. So fixed costs were $12,000 higher than expected. To adjust for 1,800 units, we subtract this excess to get the correct budgeted fixed overhead. Now we are going to calculate the profit. So there is a formula for find out the profit. Sales revenue minus total cost is equal to profit. So the sales revenue, which is this, minus the total cost is 43,200. This is, now we are going to add all the costs, whether this is material cost or fixed cost or direct labor cost. 43,200 plus 108,000 plus 72,000. So this is equal to 10,800. The profit. So flexible budgeted profit is equal to 10,800. And the actual profit was 4,740. So the total adverse variance okay, the total adverse variance, because the but flexible budgeted profit is 10,800, but the actual profit was 4,740. So what is the adverse variance? You just need to deduct the 10,800 from 4,740. So you have the answer for total adverse variance, which is 6,060. Okay. So basically, if actual profit was lower than the flexible budget profit, it means that company performed worse than expected due to additional and unexpected costs. Okay. So now we need to prepare. Okay, so now we need to prepare a statement of reconciling the flexible budget profit in C with the actual profit. Okay. So basically what we need to do, basically the reconciliation statement helps us to understand that why the actual profit, which is 4,740, is different from the flexible budget profit, which is 10,800. So by analyzing all the variances that affected the final profit. Okay, so first of all, the sales revenue. What was the formula for this? The sales revenue minus total cost is equal to flexible budget profit. Okay. So basically, what we are going to do to reconcile the flexible budget profit with the actual profit, which is 4,740, we need to add or subtract the actual variance recorded. Okay. So first of all, the flexible budget profit was 10,800. Okay, and because the sales price variance was variance, which is 5,400, so that's why we need to add this. Sales price variance, which is favorable. Okay, and the total direct material variance was adverse, and that's why we need to subtract. And the total direct labor variance was favorable. That's why we will add back this into the flexible budget profit. And the total fixed overhead variance was adverse. That's why we need to subtract it. So the actual profit is equal to 4,740. So the actual profit for 4,740 is lower than the flexible budget, which is 10,080. So mainly due to the higher fixed overhead, which is $12,000 adverse variance, and higher material cost, which is 14,040 adverse variance. So despite the favorable sales price and the labor variances. Okay, so your actual profit is equal to 4,740. Okay. So basically, this reconciliation explains that why actual profit is lower than the flexible budget profit by analyzing the sales price, material labor, and overhead variances. So the main reason of the lower profit is again the adverse fixed overhead variance, which is $12,000, despite having the favorable sales price and the labor variances. Okay. So now let's see the other question. So the actual labor R rate is August was 15.50. Explain the likely reason for the favorable direct labor variance of $1,980 with reference to the analysis of its two subdivision. So basically total direct labor variance consists of two sub-variants. First one is a labor rate variance, that did we pay workers more or less per hour than expected? And the second subdivision is that labor efficiency variance, that did workers take more or fewer hours than expected to complete the work. So we are given the actual labor rate in August, which is 15.50 per labor, which is higher than the standard rate of $15 per hour. If you just see the question again. So since this rests at an adverse labor rate variance, the favorable overall labor variance is 1980. $1980 must have been due to an even larger labor efficiency variance. So workers took fewer hours to complete the work. Okay. So with that, if you just want to calculate the labor variances, so we can calculate it. First of all, let's calculate the labor rate variance. And the formula for this is labor rate variance. The formula is standard rate minus actual rate multiply actual hours. So the standard rate was $15 minus 15.5 is the actual rate. 15.50 multiply the actual labor hours was 6840. So this will give you the answer, which is 3420 in minus. So this is basically adverse labor rate variance. So company paid $0.50 more per hour than planned. So this resulted in a 3,420 adverse variance. Higher variance is basically increase the cost. And if you just want to find out the labor efficiency variance, so the formula for labor efficiency variance is standard hours minus actual hours multiply standard rate. 7,200 minus 6,840 multiply 15. This is equal to 360 multiply 15 is equal to 5,400, which is favorable variance. So it means that workers completed the work using 360 fewer hours than expected. So this has resulted in a $54,000 favorable variance. Less time used is equal to cost savings. Okay. So basically, what are the likely reasons behind that? So the likely reasons behind that would be that there's a better work productivity, that employees may have worked faster or improved their skills, and there may have been better supervision or training. The improved work processes may be the reason why the company may have streamlined production or better tools or equipment or workflow may have reduced the time needed. So these are the main reason. Okay. So in conclusion, we would say that favorable direct labor variance is 1980 was mainly due to improved efficiency, which is like $54,000 savings rather than lower wages. And although the company paid workers $0.50 more per hour, causing a 3,420 adverse variance, they used 360 fewer hours, resulting in overall cost savings. So better productivity improved the workflows, workers, or reduce idle time likely contributed to this efficiency. Okay, so now we are going to see the last question, I guess, maybe this paper. The last question of this question. The question is that directors are aware of an upward trend in direct material price to keep the current profit level. So they have two options. Option one is that modify the existing product so that it requires a less direct material. Option two is reduce the advertising cost by 1/3. Advise the directors which option they should choose. We justify your answer. Okay, so basically directors need to maintain the current profit level while addressing the upward trend in direct material prices. So they have two options, which we just saw. So if you just talk about the option one, so basically there's a potential benefit. First of all, there's a direct cost saving that if the product required less material, the company can reduce material cost, which directly affects the profitability. And since direct material account for a significant portion of total cost, which is $24 per unit, reducing material usage can be highly effective. And there is no negative impact on the sales revenue. Okay. But there's a potential risk. Like, however, there's a quality concerns that if the product modification lowers quality, so customers may reduce purchases, leading to a drop in sales. And there is also research and development costs because changing the design requires investment in testing, prototyping, or production adjustments, so which may costly, may be costly upfront. And if you talk about the option two, in which we need to reduce advertising cost by 1/3, so there's a potential benefit that there's an immediate cost saving. So because reducing advertising by 1/3 lowers expenses without changing production cost. And also like there's unlikely modifying the product. This option does not require R&D investment or process changes. However, there's a loss of sales volume because of advertising drive sales and reducing it could result in lower demand, leading to lower total revenue. So if competitors continue advertising, they may gain the market share. So there's also some quantitative comparisons. If you want to do, there's a current, like you can maybe um, use the quantitative information. So my final recommendation for, like, I'm going to choose option one. Why? Because it's a higher cost savings, it provides a slightly more saving, like 43,000 for, sorry, 4,320 versus 4,000, then cutting advertising. And there's no immediate impact on sales, unlike advertising cuts. Modifying the products does not directly reduce the customer demand. So, but yes, there is a condition for success. Like, however, option one should be implemented carefully to avoid the negative impacts. There are a lot of negative impacts. First of all, that you should ensure the product quality remains acceptable to the customers, and communicate the changes transparently if this is noticeable, and monitor the customer feedback after modification. So, thus the option one is the best strategic decision for sustaining the profits without risking the future sales. Okay. So now let's see the question number two. So here we have the question number two. Okay. So the source that directors of estimated are considering buying a new machine, which is $240,000 exclusively to make a new product. This is our upfront cost. Product A, the company intends to manufacture it for only 4 years, and it is estimated that the profit after depreciation will be $27,000 each year. Sales revenue will be $400,000 each year. Machine is to be depreciated over its life with no residual value using the straight line method. Cost of capital is 12%. Relevant discount factors are as follows. So we have two discount factors on 18% and 12% for year four for 4 years. So what is the question? First of all, we need to calculate the net present value. So now, like net present value, we know that it is used to evaluate whether an investment is financially viable. It discounts future cash flow to present value and to compares them to the initial investment. First of all, the initial investment was $240,000, and the machine annual profit after depreciation was 27,000 per year. And we have the discount factors for at 12%. Okay. So now, first of all, let's so first of all, let's find out that what will be the profit for 1 year. Okay. So basically, if you just see the question, the initial investment, the cost of machine was 240,000, 2,40,000, and there's a 4 year of life. That means that the investment per year is $60,000, and the annual profit after depreciation was 27,000. So it means that you receive 87,000 per year. And we have the discount rate. So first of all, now let's apply the formula for NPV. Summation net cash flow divided by 1 plus R times minus initial investment. So NPV as it is 87,000. Multiply the first discount factor for the first year's discount factor for 12% was 0.893. You can just open the question and you can see by yourself. Second year discount factor, which is 0.797 plus 87,000, multiply third year discount factor and the fourth year discount factor, 87,000, multiply 0.636 minus 240,000 is the initial investment. So NPV is equal to, if you just multiply this, so you will get the answer, which is 77,691 plus 69,339 plus 61,944 plus 55,332 minus 240,000. So at last we have the net present value which should be considered. Yeah. And now we are going to find out the IRR, internal rate of return. So basically, internal rate of return is the discount rate that makes the net present value equal to zero, and it helps determine the expected return on investment. So in first, we are going to understand the given data. So what was the initial investment, which is 240,000, annual cash flow, which is $87,000 per year for 4 years. Discount rate one was 12%, and discount rate two is 18%. Okay. So now let's find out the net present value on the basis of 18% discount factor. Okay, so I think I should find it out here. Okay. So NPV is equal to summation cash flow over 1 plus T, sorry, 1 plus RT, okay, minus initial investment. So we already calculated the value, which is 87,000. So NPV, like the annual cash flow, 87,000 multiply 0 point, for the first year, the discount factor or at 18% is 0.847 plus 87,000 multiply 0.718 plus 87,000 multiply 0.609 plus 87,000 multiply 0.516 minus $240,000. So if you just add this, so you will get the NPV, which is equal to minus 5970. So since NPV at 12% is positive, which is 24,306, and NPV at 18% is negative, which is minus 5970, we use linear interpolation to estimate IRR. So what is the formula for IRR? Is R1 plus NPV1 divided by NPV1 plus NPV2. This is NPV2. NPV1 we found in the first part. This is the formula. Multiply R's 2 minus R1. So R1 is equal to 12. This is a lower discount rate, and R2 is equal to 18, which is higher discount rate. NPV1, R is equal to 12, R is equal to 18. Okay. And NPV1 is equal to 24,306 at 12%. And NPV2 is equal to minus 5970. And this is NPV at 18%. So now we are going to substitute the information here. R1 is equal to 12 plus NPV1 is equal to 24,306. NPV1 is equal to 24,306 plus NPV2 is equal to 5,970 multiply R1 is equal to 18, R2 is equal to 18, R1 is equal to 12. So this is equal to 6, multiply the same thing, plus 12. So by dividing, first of all, you need to plus this and divide the 24,306 with the addition of these two. So you will get the answer, which is 0.8028 plus 12 is equal to IRR. So IRR is equal to, if you just multiply 0.8028 multiply 6, so you'll get the answer 12 plus 4.82. And now finally the IRR is equal to 16.82%. So this is the answer for the IRR. So IRR is equal to 16.82%. So basically IRR is greater than the cost of capital, 12%. So the project is acceptable because the return is higher than the required rate. Because 6.82% is higher than the 12%. So investment is basically financially viable. Okay. Now we are going to calculate the ARR. So accounting rate of return measures the return on investment based on accounting profits rather than cash flows, and it is expressed as a percentage. So first of all, we need to find out the annual profit after depreciation, which is 27,000. In the question they have given, initial investment was 240, and depreciation method we are using the straight line, and there is no residual value. So accounting rate of return ARR is equal to annual accounting profit divided by average investment multiply 100. Okay. So if you want to find out the average investment, so what we need to do, average investment is equal to initial investment plus final value divided by 2. Okay. So initial investment was $240,000 plus 0 because there is no final value divided by 2. So this is equal to 120,000. This is my average investment. So now if I want to find out the ARR, so my annual accounting profit, which is equal to $27,000 divided by 120,000 multiply with 100. So ARR is equal to, if you just divide this, so you'll get the answer 0.225 multiply 100. So at the end, you have ARR, which is equal to 22.5%. Okay. So ARR is greater than the required return, the project is acceptable. So if ARR is lower than the required return, so project is not viable. So let us compare this with the cost of capital, which is 12%. So since 22.5% is greater than 12%, so product is financially attractive. Okay. So basically, director adopt the NPV method for this investment appraisal and are about to make the decision to buy the machine. So sales manager, however, thinks that the annual estimated sales revenue may be only $380,000. All other information will remain the same. Discuss whether the director should be concerned about the uncertainty over estimated sales revenue. Support your answer with the calculations. Okay. So okay. So basically discussion on uncertainty over estimated sales revenue. So the director should be concerned about the uncertainty of estimated sales revenue because it can significantly impact the product's financial viability. So a reduction in sales revenue leads to a lower net cash flow, which affects the net present value of the investment. So if you see the initial investment was $240,000 and original annual cash flow was $87,000. So there's a reduced annual cash flow due to lower sales, which is now it will give you the answer, which is $67,000 and discounted is 12%. So now we are going to recalculate the NPV with reduced sales revenue. Okay, so NPV is equal to again summation reduce net cash flow, summation reduce net cash flow over 1 plus RT minus initial investment. Okay, so reduced net cash flow is equal to NPV 67,000 multiply 0.893 plus 67,000 multiply 0.797 plus 67,000 multiply 0.712 plus $67,000 multiply 0.636 minus 240,000. Okay, so NPV is equal to 203 546 minus 241 is equal to, now NPV is equal to minus 36,454. Okay. So interpretation of the NPV result, basically an original NPV was positive, it is 24,306, meaning the investment was viable. So the new NPV is negative, which is minus 36,454, meaning the product will result in a financial loss. So a negative NPV indicates that the product should not be undertaken under these new sales revenue assumptions. So investment appraisals depends on estimates. So like the key concerns for the directors are their forecast of sales revenue are uncertain. So if sales revenue drops, the profitability and financial attractiveness of their product decline. And the NPV turns negative. So a negative NPV means that product will not generate enough returns to cover the investment. So if actual sales revenue is lower than the expected, so the company will lose 36,454 instead of gaining value. So directors may need to reconsider investment. So if there's a higher risk of lower sales revenue, so investment should be reconsidered. And the company may explore alternative strategies to improve the revenue forecast or reduce cost. Okay. Now, in the next question, the question is about that directors are preparing the cash budget for year 4. They have two options available for an amount of $80,000. Option 1 is that continue to manufacture product A for 2 more years by launching a promotional campaign. Despite the machine being fully depreciated, it can continue to be used for the 2 years. Option 2 is that start designing a new product B to be launched in year 5. Advise director which option they should choose, justify your answer. Okay, so basically, if we talk about option 1, so there will be advantage that there's no immediate investment needed. So company does not need to spend money on designing a new product in year 5 and year 6. This avoids research and development cost and minimize the financial risk. Okay. But however, there is a potential increase in repair and maintenance costs as the machine ages, maintenance expenses may rise, impacting the profitability. And you see the option 2. So there's that advantage that there's a long-term business sustainability. So developing product B ensures that company does not rely solely on an aging product. So this future proofs the business by introducing product that could drive long-term profitability. However, there's a higher initial cost because designing and developing a new product takes time and money, and R&D cost, prototype testing, and marketing will require significant investment. And there's also no possible need for new machines. So if product B requires different production techniques, so the company may need to invest in a new machine, adding capital expenses. So now the final recommendation, I would say that they should choose option 1 for short-term stability, but prepare for option 2. So option 1 is the better choice in the short term because it allows the company to maximize profit for year 4 onwards. There's no depreciation cost. So it was high investment risk in designing a product and it delays major expenses like buying a new machine and training R&D. So however, the company must plan for option 2 in long run because product A eventually decline in sales and product diversification is necessary for long-term survival. So a phased transition into a new product will minimize the financial risk. So final decision is that the companies should stick with the product A for now, but gradually prepare for transition to product B. So yeah, so this is what I would suggest them. Okay, so we have completed the whole paper, and we will meet in the next video with the new paper. Goodbye.